Hi, I'm Scott Robinson, Director of the REIT Center at NYU's Schack Institute of Real Estate. I'm fortunate to be co-hosting our fall REIT Leadership Series with my friend and industry colleague, Robin Panofka. Robin co-chairs Wachtell Lipton's real estate and REIT M&A practice with Adam Emmerich, both of whom have long supported the Schack Institute, notably as conference co-chairs of our annual REIT Symposium held every spring in New York City. This REIT Leadership Series was designed to bring our students and numerous stakeholders into a direct conversation with some of the folks shaping our industry. Today's conversation is with Brendan Wallace, co-founder and managing partner of Fifth Wall. Fifth Wall is the largest venture capital firm focused on prop tech with over $3.2 billion in commitments and capital under management. Brendan will speak with us about their strategy, trends in prop tech adoption, and of course, Fifth Wall's industry-leading focus on climate and decarbonization. I also want to thank the many NYU Schack students who participated in the series, including today's co-host, Ryan Alexander. I hope you find these conversations and the related research memos informative. I look forward to exploring these topics further with all of you in the coming months.
So we are thrilled to have with us today Brendan Wallace, the co-founder and managing partner of Fifth Wall, the largest and one of the most successful venture capital firms focused on prop tech with approximately $3.2 billion in commitments and capital under management. One of the interesting things about Fifth Wall is its collaboration with real estate firms. Brendan, many of the students here are focused on traditional real estate firms. By the end of this chat, maybe they won't be, and we'll only want to focus on prop tech, but for now, they're involved in all aspects of real estate. And so Fifth Wall's focus on collaboration more than just killing and displacing obsolete real estate firms is I think, very interesting to everybody. So if we could jump right in and talk a little bit, just to kick it off, about the Climate Fund, because you just launched it. Fascinating to me. You're known, obviously, for prop tech and being hugely successful in that area. And that's a massive area, as you point out in your various materials. Why expand into climate? What's the thinking?
Yeah, it's a great question, and maybe I'll give you kind of the historical arc of why we launched our climate fund. Because when we started Fifth Wall, our first fund we announced in 2017. The thesis was that there is this broad kind of secular collision between real estate, which is a massive industry, the largest asset class in the U.S., 13% of U.S. GDP, and tech. So the thesis was kind of there's the kind of Mark Andreessen quote, "Software is eating the world," which I largely agree with. And if it eats 13% of the economy, real estate, a lot of value is going to be created. So the whole thesis was just, sit atop that collision. At the outset, the bulk of where the value was being created in that collision was really just in software, right? That software, literally software, so bits, lines of code, is colliding with these kind of major industries, whether they be asset heavy, old world industries like real estate and agriculture and construction, or even newer industries. And that was the bulk of where we invested. So if you look at kind of our fund one investments, it was in like enabling software for leasing and asset management for the commercial, office industry, or a lot of fintech solutions around the home purchase transaction for the American consumer, like streamlining that purchase decision and all the ancillary products you have to buy alongside that with tech. But the core of where we were investing, like if you actually looked at where the money went, it was going into the lines of code, companies that manufactured lines of code that in and of themselves were products. And that is what we thought of as prop tech. And I think that's how most of the world thought of prop tech. But one of the really interesting things was that we deliberately avoided anything that had to do with atoms. So we didn't mind moving bits of code around, but once you started moving atoms around, it got very complicated. In my mind, that was at the most essential level, real estate, but then, at a more kind of tech, new company level, that's like, new businesses, but like new hardware businesses. We never wanted to invest in that. But then I guess about 3 years into running Fifth Wall, one of our corporate LPs on the West Coast that was probably first exposed to what major tenants started to care about around sustainability came to us and said, "We love what we're doing with you around all these new software applications, but we need help around selecting batteries for our assets. And we're looking at installing solar at a bunch of our assets, and microgrids and EV charging, and, smart glass and carbon sequestering concrete. So suddenly, they wanted us to look not just at software, but at atoms, at literally hardware. And we weren't very well equipped to do that. And so the question I first asked myself was like, why? Like, why does the real estate industry care so much about this? And I started to uncover the massive decarbonization problem that confronts the real estate industry. Most people think of the real estate industry as, contributive in some sense to the climate crisis, like all industries, but most people are unaware of the magnitude. So like most of the spotlight is occupied by transportation and, heavy manufacturing and agriculture. Like those are the kind of culprit industries you think of when you think of the climate crisis. Real estate is 40% of all CO2 emissions. All of transportation, commercial and consumer, is 20%. So real estate, which is both residential and commercial, is twice as impactful, twice as CO2 contributive as.
Where is that coming from when you say 40%? Like what emits it?
What emits it? Moving stuff in, well, first buildings in the first place, that's the embodied carbon. That's roughly about 11% of all CO2 emissions are construction. So just getting materials, assembling those materials, verticalizing those materials, and, in some cases throwing out a lot of those materials, that's about 11% of the global CO2 problem. So for example, like if you looked at concrete, if concrete were a country on its own, it would be the third largest emitter of CO2 after the US and China, just concrete curing. So materials is a massive part of it. The other part of it is
that should be a song or something. If concrete were a country.
Exactly. You had like Cementistan, right? It would be a massive CO2 contributor.
Right.
And then if you look at like just the operations of homes and buildings, you're heating them, you're cooling them, you're doing things in them, you're cooking in a home, or you're manufacturing things in a building, and you're typically moving things in and around them. And that takes a lot of energy. Certainly depends on climate, depends on your electricity mix, but that is about 29% of all global CO2 emissions. So even if we didn't build another building, buildings would still be the most contributive industry to climate change. And the real estate industry has historically been it's invested very little into the tech to decarbonize it. So most of these buildings that you read about, where they're like carbon neutral or carbon zero buildings, they're not. Even if you were to build a building with purely altruistic aspirations, if you just wanted to build a carbon neutral building, you couldn't, in fact. So all those buildings are getting there by the virtue of using offsets, meaning even if you deployed all the best energy saving technology and all the most energy efficient materials at an asset, you get about halfway towards carbon zero. So it's this massive delta. We're rooting for new technology, hardware, materials, building systems technology, renewable energy on premise, to become widely adopted for real estate owners to collapse that 50% gap. And the real estate industry suffers from this collective action problem, which is unlike other industries where there's kind of an oligopolistic structure where like a handful of big names can invest quite a bit and build their own venture arms. And, there's kind of the ability to actually invest in a lot of that technology. The real estate industry has not, at least historically. So we did an analysis just based on public information. We looked at all the REITs out there, and we looked at how much all of those REITs over the last 10 years had invested into climate tech. And over 10 years, the aggregate number was $96 million. It's estimated the cost to decarbonize just the US commercial building stock, so just commercial buildings in the United States, is going to cost $18 trillion. US GDP is 20 some odd trillion dollars, like 21 trillion dollars. So that roughly means that if we're going to do this the next 20 years, 1 year of GDP over the next 20 is just going to go into retrofitting our buildings. So our thesis was, this is an enormous problem. It's a collective action problem, which is kind of what we built Fifth Wall to do, like help the real estate industry solve this collective action problem by pooling their capital and resources and distribution together and invest into the tech, in this case, atoms and hardware and stuff, physical stuff, to help it decarbonize. So it's kind of borrowing from the lessons of prop tech, but applying it to this new mandate of helping the real estate industry decarbonize because the challenge is so daunting in front of it.
So have you made specific investments yet, or are you targeting specific things you can talk about?
Yeah, so we've invested in a lot of different companies, and I would say they kind of run the gamut. So it's everything from battery companies. As you can imagine, batteries is a big part of the solution here, because buildings being able to store energy and pull energy off the grid and use that energy is one of the major drivers of the solution here. Every building and every home in the US and the world will eventually have a battery in it. So it's a massive opportunity around batteries. And then say related to that, the electrification broadly of the building, which is building microgrids and EV charging on premise. So I call that the electrification of assets is kind of one core thesis. Another part of it is materials tech. So everything from smart glass to, we actually invested in a carbon sequestering concrete company. It's actually a carbon negative concrete. So kind of mitigating the challenge that concrete, which is the world's most used material after water. Actually, water is the most used material, but concrete's right after that, more than wood, generates such large CO2 footprints wherever you build a building. Can we actually mitigate that on the embodied side of the problem? Reg tech. So as you can imagine, there's going to be a lot of challenges around reporting on the operational carbon footprint of a building. So everything from the building management systems that actually can render efficiency at the asset level to reporting back at an asset level or a portfolio level. And then, pretty sci-fi out there stuff as well. Everything from green hydrogen forges that could work to basically provide green hydrogen or inject green hydrogen for industrial real estate assets, to we invested in a company called Source Water that uses, ideally renewable energy on premise to take, atmospheric water, so just ambient water, the humidity in the air, and make water. So literally drinkable, potable water. So it kind of runs the gamut of a lot of different solutions, but pretty much all of them touch on physical stuff that's going into the asset. The way we think about it is, if you go back to that $18 trillion number, the number it's going to cost to retrofit assets, we're looking at what are the big spending categories. So of that 18 trillion, what is that going to go into? It's going to go into steel, glass, concrete, batteries, solar installations, EV charging, microgrids. Those are kind of the big spending categories, and we're investing in all of those.
Very interesting. As you talk, I'm realizing that the scale is pretty extraordinary. Maybe not as big as prop tech, and let's talk a little bit about that. It sounds like in the climate fund, you're applying a similar model to what you have on the prop tech side, which is working with incumbents in addition to disrupting in certain cases. Can you walk us through the basic model of collaboration versus disruption in the prop tech space? I think you call it enabling type of technology.
Yeah, I think the reason I call it enabling is because I hate the word disruption, because it's kind of it's not really descriptive about what technology is doing to most industries. It's just competition. It's just usually technology, affords the opportunity to build new business models. Those new business models are sometimes better than the old ones. And so Ubers are better than taxis, that is, I don't know that you call that disruption. But people need transportation. There's better ways to do it, right? If you enable mobile technology and the web. I think the challenge with real estate is that there's really no software technology that I think will alleviate the responsibility to put roofs over our heads, right? That we conduct the bulk of the economy indoors under roofs. So I don't really see that being disrupted in any way. I don't think software is going to keep the rain out no matter what we do. We're still going to need physical assets to conduct the economy and to make civilization. I do think that there is a dynamic where many, and this is maybe a bit more philosophical, but I think it's important to understand about real estate, which is the bulk of where innovation has happened is it's happened in purely information technology, the web, and that was kind of a lot of where venture capital went. And then we made small things smart. So, we're all working on computers right now that are, roughly this big, and we have smart watches and we have smart tablets. And now you could argue maybe we have kind of smart cars. But once you start getting bigger, the ability to make big things smart has been challenged. The most extreme example of which is a building or a home. Most homes, most apartments, most assets are just not smart. It's very hard to make something big smart. And that is in essence what prop tech is doing, is trying to make big things smart. And by virtue of making them smart, there's all this added value, this kind of derivative benefits, the data that can come off of that, and how you can use assets more efficiently and operate them more efficiently, not just with respect to energy, but in terms of just how people engage with that asset. So that is what I think of software and prop tech is largely doing. There are some kind of peripheral examples where that's not the case, where it's just literally helping you buy or sell these assets, right? So like all the fintech solutions we've invested in are less about making the asset smart itself. It's more about rendering efficiency on the process of buying or selling or financing it. But that is how I think of prop tech. So that's kind of part one, I guess, in answer to your question. The second part of it is collaboration, which you asked about, which is a lot of venture funds take I wouldn't call it adversarial, but it's kind of a dismissive view about like, oh, you have these old companies that were built in an analog, non-digital, non-kind of web-enabled world, and they're dinosaurs. And oftentimes that's true. But like I said, I don't think any software is going to disrupt the necessity of having roofs over our heads. So it's hard to disrupt real estate. So I think of real estate, exactly as you said, as more of an I think of technology as more of an enabling intersection with real estate, which is how do we apply technology to make big things smart, and in so doing, use those big things better, right, to conduct the economy. And to do so, I thought it would be a huge advantage to have the involvement and the collaboration and the cooperation of the largest owners and operators and developers of real estate. So our funds, probably about half of our $3.25 billion is actually from non-traditional investors. So non-traditional limited partners. These are companies whose primary business is real estate. So Marriott, Hines, Related, British Land, Mitsubishi Estate. These are real estate owners. The primary thing they do is real estate. However, in doing real estate, they're not very good at doing technology. And that's where we came in. We said, well, what if we could pool all of them together? Now we have 110 of these strategic LPs across our network, engage with them, understand their pain points, understand what they care about, understand where technology can, make the business of doing real estate better. And that's been our model. And so in prop tech, what that kind of offers us is the ability to go to an early stage, company, a software business, and say, hey, we understand how the largest commercial office landlords in the US, in Asia, in Europe, in the Middle East, what they care about, which technologies they're looking to adopt. And if we invest in you, we can open all these distribution lanes to accelerate the growth and adoption of your particular technology. And that's been our model. In the case of climate tech, I would say it's similar, meaning it's kind of solving this collective action problem, but the dynamics are different because software tends to be more idiosyncratic to asset class, meaning like the software that a hotel owner is looking for versus the software that an office owner is looking for versus an industrial owner. There's such different use cases that the software and how you make a building intelligent varies quite a bit. It's very sector specific. Whereas using less energy at the asset, it doesn't matter what you're doing at the asset. You can be a resort, you could be a industrial facility, you could be a biotech lab, you could be, a home builder. It doesn't really matter. You want to use less energy in, both building and operating assets. So it tends to be less sector specific. But that's kind of the relationship between the two. Does that answer your question?
Yeah. No, very interesting. So in terms of these corporate partners / investors, is the way it works, trying to simplify it, that you basically say, invest in the fund, we'll help create products, and then we think you should use those products. So you're actually creating a market for the products you're investing in. Is that kind of the virtuous cycle there?
That's the North Star. I wish it were always that simple. Meaning the archetypal example is like real estate owner has this pain point, but they don't know how to solve it. They want a technology solution that will solve it. And chances are, if it's one real estate owner, it's many real estate owners that have the exact same problem and want the exact same solution. We then look at the innovation economy, the kind of startup ecosystem, and we say, are there companies that are purporting to solve that problem? Which is the best company that is doing so? We invest in that company, and then we help connect that company with our real estate owner operator developers. Unfortunately, the real world is a little more complicated, meaning real estate owners have already adopted solutions that kind of work or don't work, or they're unsure, or there's kind of political challenges within the organization. Like one region has adopted one technology, another region has adopted another. So it tends to be quite complicated, but in essence, that is the thesis, which is that if you can invest in technology empowered with knowledge, kind of asymmetric market intelligence about what the largest owner operator developers care about, are going to do, or have done, that makes you a better investor. And I think that's been borne out in the performance of our funds. But that is the core of our thesis. I would say the other thing that it does, it enables a real estate owner to do venture investing for a much lower price point than they could on their own. Meaning, if you're a real estate owner and you want to start a venture fund, it's quite expensive to start a venture fund, especially nowadays. There's a lot of money in the ecosystem. And so you need literally hundreds of millions of dollars to even be relevant. And anything less than $1 billion, you're not super relevant in venture. Most real estate companies don't have $1 billion lying around to start a venture fund. So we were able to make much smaller the aggregate commitment they could make, but by pooling all those commitments together, we created a very large pool of capital. So it's kind of like it's almost like an industry cooperative in some sense, where by virtue of contributing 10, 20, $30 million to this big pool, we can create a very large pool of capital. We have the commercial incentives to identify the best technologies. And there's this dynamic where, despite what I said about different sectors having very idiosyncratic needs, if you're a commercial office owner in Los Angeles, chances are your pain points, your challenges are not that different than an office owner in London or Tokyo or Abu Dhabi. They kind of all care about the same thing. So we have almost like intellectual economies of scale, because we've looked at so many of the same pain points for so many real estate owners in so many different geographies.
No, it makes total sense. I mean, it's thinking just about REITs. The market would never tolerate a REIT suddenly taking $1 billion and putting it into tech.
Well, it has been done, actually, I would say, with limited success. Like a lot of the real estate industry is a high ego industry, right? Like many real estate owners at some point in time think they can do everything.
Right.
I can own and operate assets. I can lease my own assets. I can develop my own assets. I can buy other people's assets and do them better. So it's unsurprising that, actually kind of predating Fifth Wall, a lot of what you saw in prop tech or in kind of venture for the real estate industry was real estate corporates dabbling in the space, typically unsuccessfully. It was like, the person at the office who used Facebook the most was battlefield promoted into being a venture capitalist the next day. And the challenge is that there's probably no two industries that are further apart than real estate and venture capital, because real estate is, an equity and debt finance business. It's kind of, in some sense, monopolistic, at least around location. It's generally low intellectual property in terms of, the asset class, and it's cash flowing. Whereas you talk about, venture, it's pretty much all equity finance. It's cash flow negative. It's very high, intellectual property. That's basically the only asset. Yeah. So they're just two very different industries. In almost every respect. So it's very hard to be good at both. And I think we've yet to see a good example of that.
So is there an example that comes to mind of a portfolio company that kind of hit that North Star? You got investors from, say, retail, and then you had them all buy into that type of asset. Something come to mind?
Yeah, I'll give an example, maybe just because it's very easy to understand, and it's not so boring. Some of the technologies we invest in are very boring, but it's kind of exciting. Is we worked with Lennar, which is one of the largest, at the time, was actually the largest US home builder in the US. And they have this challenge. They build homes, they sell homes, they market those homes to consumers. But then when the consumer wants to go from, say, a 3-bedroom to a 4-bedroom, they kind of lose the relationship with the consumer. And so as opposed to buying another 4-bedroom from Lennar, they buy from Toll Brothers or D.R. Horton down the street. And so Lennar wanted to retain the relationship with customers. And there were these companies or this new kind of type of business that had emerged in tech called iBuyers, which are almost like CarMax for homes. Opendoor probably being the most iconic example, where they will buy your home really fast in like 2 days, give you all cash, no contingency offers, and then they resell the home. But they're buying at a discount to fair market value. So they're making that spread. It's almost like a high velocity trader, except as opposed to of stocks, they're buying homes. We partnered the two companies up where when you bought a Lennar home, you bought that home with an embedded put right to sell it back to Lennar, provided that you bought another home from Lennar. So if you had a 3-bedroom, you could buy a 4-bedroom, and it's like the iPhone trade-up program. You can basically turn in your old iPhone, get the upgraded iPhone. You don't get the best value on the trade-up, but it's very kind of seamless from the consumer's perspective. Opendoor powered that program. So Opendoor was actually the buyer of those homes, and they would in turn resell them. So Lennar got to retain their customers. They got to sell more homes to the same customer, and Opendoor got guaranteed volume of home builder built homes, which is kind of exactly what they're looking for. And so we structured that partnership. We made a $70 million investment in Opendoor at the time. And then we piloted this program because at the time, Opendoor was only operating in Phoenix, which is kind of a market characterized by a lot of tract homes. And they were looking to expand. We used this pilot program to expand into Las Vegas. And it became basically 100% of Opendoor's volume in Las Vegas. And really, I think, helped the company get that escape velocity from their peer set to just grow and scale regionally throughout the US. And now Opendoor went public a couple of years ago and kind of has continued its growth trajectory. But it's a good example, I think, of like where you can use, in this case, fintech to solve a core problem for the home builder, which is how do we retain a relationship with the home buyer, after the initial sale.
Yeah, no, makes total sense. So let me ask you a question about the metaverse, and then we'll open it up to Scott, Ryan, and Adam, who'll ask the hard questions. So you've said something interesting on this session about people still need to be inside. You still need a physical world. There is this push towards the metaverse, and you've made some interesting comments about the metaverse. So I'd love to get into that a little bit. Are you in effect betting against the metaverse and focusing on the physical universe, or how do you think about that?
I would say no. I'm not betting against the metaverse. I think it's more just kind of ordinarily, I think we have more immediate problems in the physical world, right, yet to solve. Meaning, anywhere anyone is on the metaverse, you can safely assume they're under a roof somewhere, right? No matter what metaverse world they're in, or what avatar they're inhabiting, or whatever they're doing, you can safely assume they're under a roof somewhere. And you can also safely assume that the roof they're under and the structure they're in is probably not that smart, and probably not that energy efficient. And so there are these terrestrial problems related to the assets around us where we create the economy, part of which is the creation of the internet and the metaverse and these kind of ethereal ways we can spend time, right, in like the digital ether, but we still need to do it under roofs. And so where we focus is on, I guess, the more terrestrial problems, the problems of where all of us are today. I think we can, looking at the Zoom, we're all indoors as well. So that is our core focus. It doesn't mean that we're not interested and think that there's applications of blockchain and technologies that are kind of being derived from like metaverse applications. It's just that we're probably focused on those as a second order problem than, what we, where we spend the bulk of our investment attention, which is investing in tech for real estate assets.
And do you see it ultimately fusing so that, if you think of the metaverse as basically virtual reality, so just in retail, for example, is this just all fuse and somebody kind of walks into the store virtually, but you still need the store, or how do you see this?
I mean, in some sense, it already has, like the word metaverse it's kind of used pretty fast and loose, and typically meant to describe something new. But like a website, like if you go to if you go to Saks Fifth Avenue website, that's a store, right? It's a store. It's not physically instantiated, but it's designed to replicate a store, right? There's a navigation menu, and you can look at women's shoes or men's shoes just like you could in the store. There's, checkout. There's no person there, but it's very much the same use case. There's just no atoms moving around. You're not touching the shoe. You're viewing it, right, online. I mean, that at the most essential level is the metaverse, right? And we've had that for quite some time. There are more extreme versions of that where you can kind of, merge the two things, like where you could create an avatar and you could walk through what is you perceive to be a physical store, right, in the metaverse, and pick up, what you perceive to be physical shoes in the metaverse, and maybe even try them on if you wanted to. But again, no atoms are actually moving around, just bits are moving around in that process. So a large part of what we're describing as the metaverse already exists. There are ways to make the metaverse look more like the real world, and vice versa. So I think you're right that there's a fusion that's happening. I think it's just kind of this used to be called omnichannel. It was like the buzzword like 5 years ago. And it's just kind of the same thing. I think what is interesting is that a lot of, when you think about how people interact with information technology, whether we're reading the news or buying something on an e-commerce site, the experience is very two-dimensional and flat, right? And that is how we consume things, right? So even though all of us are together, we're actually all talking to screens right now, and everything is inherently two-dimensional. And a lot of what the metaverse is, what we all recognize now, and maybe COVID was this opportunity to do so, is that there's some drawbacks to that, right? Talking to a computer all day or staring at a screen all day is maybe not exactly what we would want to be doing, or is not the the optimal state of affairs. And so people miss what was happening in the real world, right? And so there's the people want to go back to malls, and then they want to go back to offices. But the reality is that it's probably somewhere in between. You can replicate a lot of the experience of going to a mall or going to an office with what is being called the metaverse, where you can kind of create these virtual worlds that look three-dimensional, borrow a lot of the technology we're using right now to create an experience where all four of us could be sitting around a table, and it could feel much more real. There could be this like visceral experience of all sitting at a table. And that's the metaverse. But it's really just taking what is today a two-dimensional experience, this conversation, and rendering it into a three-dimensional experience. Or we could just all meet up and do this in person, and there's, advantages and drawbacks to both. This makes it very easy because we're all just staring at a computer. Whereas doing it, in person has certain advantages, but we'll have to arrange our schedules to do that. So I think everyone's kind of arbitrating the drawbacks, but you are seeing this fusion of the two things.
Yeah. Interesting world. Well, I could go on and on about this philosophical stuff, but Scott, Ryan, you want to bring it back to the real world?
Yeah, I appreciate it. Thank you. Let's pivot a little bit to construction. Brandon, you spoke about addressing climate issues and solving pain points in real estate. There's been a lot of talk about modular construction and prefab, kind of addressing, items in both of those two ecosystems. But I feel like the sector is maybe under-delivered a little bit relative to promise. But nevertheless, you guys have been supporters of the sector. You've made a couple of investments in there. Can you talk to us about your thinking about modular in that ecosystem?
Yeah, I mean, you're right. It's this category that's held so much promise for so long, and yet you haven't seen the emergence of like huge businesses in the space, which is like a little bit perplexing, because you're like, well, construction is such a large part of the economy, and it is in large part of a manufacturing business. There is an element of some buildings are of course bespoke, and you couldn't just assemble in a factory, but a lot of the stuff around us, you could. And so why has it not, why is it not taken off as a sector? I'm not sure I have a great explanation for that. And I think one of the challenges is that it's just such a daunting problem to solve. So I think everyone is familiar with the very high profile failure of Katerra, right? Where they were trying to verticalize the entire supply chain of, how you build, in their case, like multifamily assets, everything from building trusses, at industrial scale down to like the actual rivets you're using. It's just very hard because you need so much capital to build that business. It makes the business of manufacturing cars and like what, Tesla has done, it makes that look like actually fairly easy. It's that daunting problem. So I think part of it is just the scale of the problem is so big. I think another part of it is that what typically happens with a lot of modular construction solutions is that you can kind of build for lack of a better word, the Lego pieces, right, in a factory. But then when you assemble them, you have to connect them, not just physically, it's not actually a Lego structure. You have HVAC and you have electrical, right, that needs to be run through it. And those tend to be very expensive propositions to hire the trades to go install those. So a lot of the benefit you got in assembling offsite is undone on-site when you actually have to, run HVAC units and ducts and electrical and plumbing through those Lego pieces. So actually the two companies that we've invested in the space, one is doing kind of row homes. What they're doing is they're trying to build the same Lego pieces that can be assembled on site, but build them with plumbing and electrical and HVAC already installed in the actual units themselves. So you are now literally just down to the aesthetic decorative work on the inside to make it look like a livable or inhabitable space, which is also challenging and requires very expensive trades as well. But part of it is that I think a lot of the companies that started in the space were very focused on the materials problem, which is a part of the problem, but it is also a specialized labor problem as well. And so I'm optimistic that we'll see more modular construction companies that are thinking about the problem holistically, such that, if you think about building a piece of furniture that you buy from IKEA, I mean, sometimes it feels very frustrating to do so, but the presumption is that you don't need to be a handyman to build that, right? That the average consumer can follow the instructions and assemble their furniture. You actually want to make real estate assets that simple, right? Where it could be done without any kind of specialized expertise. And that's been kind of the holy grail of modular. I think that a lot of the solutions that will be successful will attempt to do that, but with a very particular use case, meaning they'll be focused on a very particular kind of highly structured asset, like particular SKUs that they're just making over and over and over again. And so we've seen some interesting companies. We've invested in a couple of them, but they're both very early, into that process.
Got it. Well, it's funny too, what you mentioned, material, obviously supply chain issues, but you're still using the same amount of material and labor is still there right now. But I think another way to look at the prefab space is thinking about the upfront design aspects, which is probably more of a SaaS solution, as opposed to in the factory, more of like industrial robotics type of solution. Are you guys focusing on either of those sectors a little bit more or less, or are you really kind of going after a holistic player and leaving that granularity to them?
It's a great question, because I think you're totally right. And there's two parts to it. There's kind of a CAD and design element, and then there's actually the materials and the fabrication. There's even more components to it, because then you also deal with the kind of industrial, and the logistics risk of well, it's not enough to just have a bunch of, Lego pieces in California if you're building something in Florida. So there's a whole bunch of kind of disparate problems that all need to be solved together. I think our view is that they're going to have to be solved vertically, meaning you're going to need some kind of software suite that ideally is proprietary to kind of make these units and have them be maybe somewhat customizable, but probably not a lot of degrees of freedom. Then you need to actually have the fabrication that it can be done at scale and rely on the least amount of skilled labor as possible. And then you need to be able to do this and build these fabrication facilities in such small formats that are relatively proximate to where there's demand for construction, so that you can satisfy the demand for construction without shipping Lego pieces across the country or across oceans. So our view is that you kind of need to solve all three together, unfortunately, which is partially why it becomes such a problem. And comparing it to the companies that a company like Tesla, for example, Tesla kind of has this problem, but not really, because the things they're making roll. So you can make a Tesla in Texas and pretty readily get it to New York to sell. That's not the case, with a row home. You can't make that home in Texas and have it, be constructed in New York. So there's just a complexity to it, which is one of the reasons why I think we've yet to see a modular construction company emerge that's very, very, very large.
Well, it's
What
funny that-
about 3D printing of homes? What do you think about that whole area?
I mean, it works. We've actually invested in a 3D printing company. I think the applications are pretty limited, right? So you're kind of dealing with pretty simple structures. I mean, that's kind of what it lends itself to, is like you need to build a very basic structure that has some limited applications. You can build a home, but it's not a kind of home that most people would want to live in the US at least. So there's certain drawbacks to it, but it can certainly reduce materials waste. It can alleviate a lot of the kind of design complications, and it can build 24 hours a day. So we've done an investment in that space, and we think it's interesting. I think it will just be a lot of time before it evolves into you printing 2-bedroom homes on site. I think we're quite a ways off from that.
Brandon, one of the things I love about teaching is my students are always asking me questions that I usually don't know the answer to, because they're thinking about their careers and where the industry might go. And this is one of the reasons why Rob and I like to invite students to these conversations to ask people like you about the future aspects that are career related. So I'd love to introduce you to Ryan Alexander. I think he's got a few questions to ask you on behalf of our students.
Great.
Yeah, so just wanted to thank you again on behalf of all the students in my program. I know that everybody is really looking forward to this entire series, specifically hearing you. So to start off, my first question from kind of a student perspective, many students in my program aspire to be entrepreneurial and to develop and operate their own buildings. And of course, got to start somewhere. So that's going to be probably very small, at least initially. So what prop tech do you see as being the most advantageous and most exciting for these smaller owner operators?
Is there a particular asset class, just so I can make my answer a little more specific?
Yeah, I would say that based on my interactions with other students, I think the most popular starting off point would be, a small multifamily triplex kind of thing. I think that's where most people start off.
Yeah, I mean, I'll give the honest answer, which is that no matter what technology won't be the driver for most real estate entrepreneurs why they're successful or not successful at a small scale. It will be actually totally dependent on real estate capital market dynamics, meaning did they buy the right asset at the right price at the right time, finance it at the right levels? Like that will be 99% of success or failure. Success or failure will not be dictated by the technology they do or don't adopt. And part of that is what we talked about at the beginning, like real estate is very hard to disrupt. So I think the first thing is probably not to lose sight of that point, which is making the right real estate decisions is priority number 1 through 50. Making the right technology decisions, I think, can be very impactful, but it is going to be marginal. But for most